Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. One of the things that I've been doing in the last few weeks is to go through the entire portfolio and talk about companies that we haven't spoken about for a while. And today's video, we're going to focus on S&P Global. But before we do that, I wanted you to join us on the Discord if you can by joining us on the Patreon account first. You get access to a lot of things, including the Sharia compliant investing ebook, as well as then you can join us on the Discord where we're trying to build brothers and sisters who are very much like-minded, who are helping each other to invest in the stock market the halal way and so on. So if you can do that, that will be absolutely brilliant. Now the company we're going to talk about today is S&P Global, and this company, okay, if we look at this, basically provides credit ratings, benchmarks, analytics. They provide a lot of basically insight to global capital, commodities, automotive markets. It operates through 6 different segments. So global ratings, S&P and Dow Jones indices, and S&P Global Commodity Insight, S&P Global Market Intelligence, Global Mobility, and Global Engineering Solutions. So they've got loads of different types of product, and is one of those companies that have really very easy, predictable kind of business. When the economy is doing really well, this company obviously tends to do well. So for that reason, it kind of makes a little bit cyclical kind of business. But it is actually up year to date about 13%. And year to date is up about 18%. For the 1 year is up about 12%. If you hold this company for the last 10 years, you would be up about 400, basically closer to 500% in the last 10 years. So you buy it, you forget about it. You've been 10 years down the line, 5 years down the line, you will be about 85%, and then basically almost 500% in the next 10 years. What I'm going to do now is go through the financials. But before we do that, I just want to show you the revenue side of things. Okay, their revenue breakdown is this. Okay, and as you can see here, that you've got 5 different sections, and it's very much diversified, and it's actually gone up from Q2 of 2022 to Q2 of 2023. You can see there's a slight basically increase from where it was, and I like the fact that it's quite well diversified. I'm interested in buying companies who have, you know, very much diversified portfolio of revenues and products and so on, rather than just 1 or 2 products that if anything happens to that, then the company obviously loses, or they lose shares to another company and so on. All right, now we're going to look at the financial side of things, and then I'll give you my view of what I want to do with the company going forward. Like I said to you earlier, it's in the financials. S&P Global is the name. $396 per share is where the price is at right now, and they have EPS, $7 of EPS. Market cap is $126 billion. So it is a quite big company. It has a wide economic moat, and it has a beta that's slightly higher than 1. In terms of PE, we're looking at about 54 right now, which is quite expensive, but the forward PE is only 31. And when you look at the markets, normally for the financial sector has a very low PE anyway, but when you compare it to the S&P 500, okay, it's about 25 right now, and when you compare it, that it seems a little bit pricey according to this. The 5-year average is about 29. So according to the 5-year average, basically this seems very, very expensive. Price to free cash flow right now, we're looking at about 39, and PEG ratio just basically above 2, which again seems a little bit expensive. So looking at this, it seems really on the higher side. However, looking at the 5-year average, okay, of basically the 5-year PE average of 29, or maybe a 30, and the future, the forward PE are more or less in line. So for that reason, it could be fairly valued right now. Maybe if you were to look at this company, we'll look at the rest of the what the analysts are saying right now, but it might seem a little bit too expensive. Again, it depends on the growth of the companies, which we will be looking at in a second. Right, in terms of dividend, they've got 1% dividend, just less than 1%. Payout ratio is only 30%, which is really good, because that means they can increase this dividend as much as they want to in the next few years. Latest increase was about 6%, and the 5-year growth rate about 15%, which is really nice. The dividend growth streak is about 49 years, so that means 1 more year this company becomes dividend king, which is the companies that have increased their dividend for 50 plus years. The annual payout is $3.60 right now, and the dividend safety is 99%. They have free cash flow of over $3 billion, and free cash flow yield of just 2.5, below what we're looking for normally, and free cash flow margin of 26%, which is quite nice. In terms of profitability, there's no issues there. 20% in terms of profit margin. In terms of operating margins, 30%. Return on equity, we're looking about 6%, 7%. Total return in the last 10 years, 21%. Return on invested capital, about 8%. And then in terms of revenue in the last 5 years, when we look at the compounded annual growth rate over the last 5 years of the revenue, we're looking at about almost 30%, which is really huge. Current ratio should be above 1, but it isn't right now. But the company has basically a little bit of money in the bank that they can liquidate or use it, whatever. Okay, normally we're looking for anything above 1, which means the company is able to cover any liabilities they have coming up in the next, all the current liabilities for the next 12 months. Now, in terms of growth, this is where the company shines. So double digit, 15% next year, and then 13% every year after that. If we go here and go to earnings, for example, what you would see here is actually quite impressive. In terms of the growth side of it, we're looking about almost 12%, 15%, 13%. If we just focus on the first three, so we've got 23 analysts, 23 and 17 analysts there. So double digits basically growth in terms of EPS, and in terms of revenue, again, basically 5%, 7%, 7%, which is decent, sort of from $12.4 billion to $14.3 billion, okay, in the next 3 years again. So it is doing well in terms of basically growth side of it, and that's probably where that information comes from. Current price is $396 per share, and fair value right now for this company is $375 per share, according to Morningstar, and they're saying it's about 7 to 6% premium, and I do agree with them. Okay, I do agree it's slightly overvalued right now, but when it comes to simply Wall Street, they're saying it is overvalued by 80%, because they expect the price to be $219 per share. In terms of target price from Tip Ranks, is saying $452 per share. Again, 14% upside is a strong buy from them. Same goes for Morningstar, basically Seeking Alpha, 12% upside and a strong buy. In terms of Sharia compliance side of it, there's no issues there according to Zoe. So 100% in terms of business side of it. Interest bearing debt is about almost 10%, and then interest bearing securities just below 2. Now, they have been buying back their own shares, and then last year they've increased it because they actually acquired another business. I think they used that money to finance that, of course. And I do like companies but that buy back their own shares, but sometimes this is inevitable. Sometimes in order for the business to grow, they might need to issue more shares, and then obviously start buying back their those shares in the coming years. Once that business becomes part of it and the EPS grows and the businesses start making more profit, they start buying back those own shares. So I like the fact that they have been buying back for almost 10 years, and then obviously dilute a little bit, and hopefully we'll buy back those shares in the next couple of years. Like I said, I hate when companies basically just buy back their own shares when the price is too expensive. So the fact that they're diluting, maybe they thought, you know what, the price is too expensive right now, let's issue more shares, use that money to build it, and basically to reinvest in the business. That's okay. I just don't like when companies just dilute your shares for no reason. So, but in this situation, to actually acquire another business is absolutely fine with me. And now looking at the revenue side of things, so where basically the breakdown of the revenue. So you can see the S&P Global Market Intelligence side of it. You can see it's actually grown from $1 billion to basically still little bit higher from Q2 to Q3 of basically Q2 of this year. So it's about 6% growth in there. And if we look at the EPS, basically adjusted profit and expenses, you can also see it's actually kind of gone up a little bit. Now looking at the global ratings, the S&P global ratings, which is another sector or another segment of their business, it's also heading the right direction. So we're looking at about a total of 7% there. And then basically commodity inside, we're looking at about 8% growth side of things. And I really like this, the fact that it's very well diversified within sections, within the segments of this business. There are segments within that, which is quite nice to see. And then again, the mobility side of it, 10% upside in this basically the last couple of years, just that 1 year. And then same goes for the Dow Jones indices as well, which is basically up about 3%. So it's a really solid business. I like the business model. I like the predictability profitability. I like that a lot of companies rely on this company, governments rely on this company to actually give them credit ratings and so on. So moving forward, what am I going to do? I own 12 shares. I want to own a minimum of 20 shares, maybe in the year or so coming. But right now, I'll be honest with you, because I'm up about 11%. There are a few companies that I'm still down, so I'm not going to touch it yet. If it comes down maybe 7-8%, okay, then I will definitely start buying back again. Like I said, the valuation doesn't seem too expensive. The PE seems a little bit high, but because of that growth rate that's going on with the business, that's probably why it's trading on higher multiples. So I'm just gonna wait. Maybe for 7-8% drop, if I get that chance, then I will probably start adding more. So we'll see what happens in the next few months, but that's what I wanted. Well, that's what I'm going to do, inshallah, moving forward. And as always, I'll be honest, transparent with you guys. You might see Tesla here, by the way. That was a share that one of you guys actually used to the link on the description section, and I got Tesla for as a basically free share, if you like. So it's not like I'm buying Tesla. There's nothing wrong with buying Tesla. I really like Tesla, but right now I'm not buying that, of course. So yeah, that's the company that I wanted to share with you guys. I hope you're enjoying this type of content. If you are, join us on the Discord, join us on the Patreon account, join us on the, basically like the video, subscribe to the channel, obviously. Let me know if you also have any questions. I haven't looked at the comment section on the videos lately, because it's genuinely don't have a lot of time. So, but I'm answering a lot of your questions on the Discord. So if you're on there and you're asking questions, I will get to it, inshallah, as soon as I can. Have a wonderful day. Assalamu Alaikum.